Good afternoon and a very warm welcome to the AFME Digital Bond webinar. My name is Vicky Webster. I lead AFME's work relating to bond trading, and I will be moderating today's panel where we will be taking a closer look into aspects behind the European Investment Bank, the EIB, digital issues. Now, having issued their first digital bond back in April 2021, the EIB was very much at the forefront of the distributed ledger technology, not easy to say, or DLT, much easier. And just over 18 months later, they issued a second euro-denominated bond. That was in November 2022. And again, earlier this year, they're at it. On the 31st of January, they took another step forward and issued their first ever sterling-denominated digital bond. And that was really cementing them as a leader in digital bond issuance and innovation by the use of a combination of public and private blockchains. Now, to discuss the details behind these digital bonds, it's my pleasure today to be joined by a distinguished panel of industry experts that have all been involved in bringing these deals to the market. So panelists, welcome. Let's start off by briefly introducing yourselves, please. Let's start with Xavier at EIB.
Good afternoon. My name is Xavier Leroy. I've been working at the EIB for 15 years, and I'm a senior funding officer in charge of new product and special transaction. And in this regard, I've been dealing with the various blockchain-related projects that the bank has been issuing.
Thank you, Xavier. Dan?
Good afternoon, everyone. So my name's Dan Fletcher. I'm a debt capital markets partner with Allen & Overy in London. And digital bonds and related FMI projects have been part of my practice now for a number of years, having advised on Santander's original D-bond issue back in 2019 and a number of similar projects since, including EIB sterling transaction earlier this year.
Thank you. Philippe.
So hi all, I'm Philippe Nolpner. I'm a senior associate in our Luxembourg team, and I've been with Allen & Overy for now almost 8 years. And the last half of which have been involved in DLT projects. So I had the pleasure to assist on the two latest Luxembourg law-governed EIB bonds. So that's Project Venus and Project Mars. So glad to be here.
Lovely, thank you very much. Matt.
Hi, hi, I'm Matthew McDermott, and I run the digital asset business at Goldman Sachs, which I've done for the last 3 years. I've been at Goldman since late 2005, been here a while.
Thank you. And John.
Yeah, hi Vicky, I'm John O'Neill. I'm head of digital asset strategy here at HSBC. And we, on our platform, which we call HSBC Orion, we did the most recent of those digital bonds you mentioned, and Philippe just mentioned the different code names. That was the most recent one called Project Mars. So that was launched with the EIB on our platform.
Lovely, thank you very much. One thing I did want to acknowledge is whilst we have several of the participants involved today, there are also other players that have participated in a key role with the issuances. So let's take a closer look at the background and also the processes involved in getting a digital bond to market. Xavier, let's start with you. What were the driving forces which really led you to consider issuing digital bonds in the first place?
We were aware that blockchain was a potential technology to change the way capital markets were functioning, especially the post-trade settlement. And we wanted to experiment ourselves because it was very clear that there was a massive difference between having a theoretical understanding of the concept or the technology and implementing it. And we discovered that when we worked on all the risk rates aspect, because EIB has also been the pioneer in all the post-LIBOR solution like Sonia in the UK and SOFR in the US and so on. And clearly we realized that the devil was in the detail, and you really had to build something in order to make it work, and it was no different with blockchain. So.
Perfect, thank you. And what factors do you need to take into account when issuing? So for example, how do you decide to choose between a private versus a permission public blockchain, for example? And did these differ between the different issuances?
No, okay, well, I think as an issuer, it's completely irrelevant And I personally don't even really believe in the distinction between public and private blockchain. I mean, certainly we have a preference as a public institution for maybe public blockchains, okay? Also because they are probably easier to integrate with any system, okay? That being said, we also have very strict KYC and AML rules that we need to follow, which means that private blockchains are way easier internally to work with than it would be for public blockchains. And ultimately, I don't think the answer is either public or private. I think it's probably going to be something in between. Like on the first transaction that we did on the public Ethereum network, yes, technically we use a public network, but we have some sort of a gatekeeper with a function that's called the registrar with Société Générale. And investors, they don't have access to their keys, right? They have systematically to go through the registrar to register any transaction. So yes, it's a public network. Is it really a pure public network? I don't think so, right? So
Perfect. Thank you very much. That's, I think, helps set the scene there quite nicely. Now, of course, anything new and innovative will inevitably need to involve a legal setup and scrutiny. So, Dan, from a legal perspective, what are the challenges and, in particular, the most notable distinguishing factors between the different legal jurisdictions out there for digital bond issuance?
Thanks, Vicky. Well, given we've got an hour, and I know we've got a lot to get through, I'll keep this maybe a bit shorter than it might otherwise be. But let me start with some foundation points and then maybe just mention a couple of the challenges. So key thing, foundation, wherever issuers, investors, deal participants are, they're going to want legal and regulatory certainty around the deal and the roles they're performing. So investors will want to know the bonds they hold have been duly constituted and can be validly transferred. They want to know that the issuer's payment and other obligations are capable of being enforced. And they want to be sure that the manner in which they hold their bonds or their interest in the bonds is going to be recognised and given effect to, so they have the rights and can exercise their rights as bondholder. Similarly, issuers want to ensure that it is clear to whom they owe their payment and other obligations under the bonds from time to time, because they need to ensure that when they make payment to who we think is the holder of record, that discharges the issuer's payment obligation, so they're not on the hook to pay twice. And then you look at the other deal participants, so that's the underwriters, the agents, custodians in the chain, if applicable. They need to ensure all those things are up to speed and accurate, but they also need to understand their own legal and regulatory obligations for the roles they are performing in the system. So they need to understand the regulatory classification of the bond, how that's treated, similarly, any related payment tokens that they are dealing with, and the services that they are providing. So they need clarity on those in each jurisdiction that's relevant. Now, in some jurisdictions, in particular civil law jurisdictions, it may be either necessary or helpful for the legislators to pass laws that specifically support these digital structures. In other jurisdictions, such as the UK, it is likely that the inherent flexibility of the common law and a strong track record of the courts upholding commercial bargains, commercial contracts, will give sufficient comfort. But there's not a one-size-fits-all approach to each jurisdiction. And so really you have to look in each jurisdiction on a case-by-case basis, identify points of friction in existing regimes and seek to address those. And so in that context, certainly having very collaborative, proactive regulators who are willing to support and foster innovation in their jurisdictions is very welcome. And we've seen a lot of that in a number of key jurisdictions. So those are foundational points, I would say. In terms of challenges, funny enough, one of the key challenges that we face to date is common to the EU and the UK. And that arises because of a piece of EU legislation that's also onshored in the UK post-Brexit called the Central Securities Depositories Regulation, CSDR. And essentially, if you want to admit any securities to trading on any trading venue in the EU or the UK, so that's regulated markets, MTFs and OTFs, then those securities must be accepted for clearance in book entry form by an authorised central securities depository acting under that CSDR regime. So if you don't have a CSDR in your tent, then you can't yet admit those bonds to trade on those platforms in the UK and Europe. Now that's, of course, one of the primary reasons or things that the EU DLT pilot regime is seeking to address, and its UK counterpart, the UK FMI sandbox. And so we'll be taking a keen interest to see how the market embraces those initiatives in the coming months. Another key challenge, and again, it's not jurisdiction specific, but funnily enough, conflicts of laws issues. So between jurisdictions, the capital markets are global. They operate cross borders. And DLT, if it is to deliver on its promise to unify and simplify record keeping, improve efficiencies, these systems equally need to operate seamlessly cross-border. Now, that does give rise to a host of potentially complex legal questions that no one jurisdiction can answer, so cooperation will be key. They are by no means new questions. We know what the right questions are, but answering them in the context of these new structures is something novel. So it may take a bit of time for the answers to come through.
Thank you for that, Dan, but clearly jurisdictional issues are a real consideration there. Philip, maybe I can turn to you. Why was Luxembourg law chosen for the most recent couple of issuances?
I think first and foremost, that would be a sort of a commercial decision to be chosen by the issuer and the lead managers. But what I can attest to is that actually, while Luxembourg law provided a robust sort of ground in order to really build these transactions. So I think Dan talking about regulators and authorities being proactive, I think that this really resonates in Luxembourg. So Luxembourg actually amended its laws back in 2019 in order to really sort of enshrine the fact that a deal or an issuance could be done no matter the technology. So I think the point here, it's about achieving tech neutrality, and sort of the way today is that intermediated securities are issued, transferred, and custody could be done via a central register or a decentralized register system. So this is really what Luxembourg law seeks to do and have done. And so we went through the first of the Luxembourg laws that was amended. It was about the custody, second about issuance, and then now a third that just passed in March is about the collateralization of the digital bonds. So the point is that, fine, you issue a bond, you hold an EIB bond, it's wonderful, you wait for the coupon, but I think it's best if you can rehypothecate the bond. And so there as well, on blockchain law 3, this is what you get in Luxembourg. So obviously Luxembourg is not alone in sort of being proactive and looking for legislative solutions that brings comfort to the market. This frameworks in Germany and in France. And I mean, as Xavier mentioned, the first deal was on the French law. However, I think there the legislators take a different approach in the sense that they may seek to give, sort of a encompassing framework that really encapsulates how the deal should be done in all aspects, while Luxembourg is more about tech neutrality. And as well, as I mentioned, the laws were changed for intermediated securities, but as well, we have more of a market view that for registered securities, so non-intermediated securities, you could also use the blockchain there. So that gives different tools in the toolbox that Luxembourg as a jurisdiction can bring. And now talking about proactive regulators, there, for example, the CSSF published a white paper whereby they actually tell market players what they would expect from them in terms of the tech and the different questions they would be asking. So I think this gives you a sense of what to expect when you bring a project to this regulator and then to the authorities. And I think there, John could also sort of speak from experience, having lived that to set up the HSBC, the EUR platform in Luxembourg, that I think there were no major surprises simply on the basis that you had the white paper. Yeah,
absolutely. Yeah, there was a lot of work going to that, and great work from Philippe and Dan to enable that. Yeah,
so I think all in all, I think it'd be I think the more interesting part of the story may come from Xavier, maybe as a commercial decision why Luxembourg is picked. But yeah, I think obviously, we have the benefit from having good legislator, having a market-friendly approach.
I mean, Luxembourg, like when we issue euro issuance, Luxembourg is the default law that we use. So all the euro benchmark, for instance, are done under Luxembourg law. So for us, if anything, it allows us to align the legal framework with what we use for traditional issuance. Plus, we wanted to test the new Luxembourgish legislation, obviously. But,
yeah. Perfect. Thank you very much, Adi, for that. Now let's take a little move down the process to look at issuance, or look at further down the process. Matthew, what, if any, are the implications of a DLT infrastructure on the KYC process?
Very good question. And I think BIS kind of highlight the potential value here when they say up to 90% of costs can be reduced in terms of the KYC AML process by actually migrating that to DLTs, so distributed ledger. Now, I think the way that it works presently, I think all of us and probably most on the call will be familiar that each bank has its own KYC AML process and standards, which naturally are deeply inefficient because there's a lot of duplication across the market. So if one is able to leverage digital identity on a DLT, that could actually have a profound impact if people can kind of agree on what are the standards. And so, you know, I think it can in the future have a very positive impact for that reason.
Good to hear. Thank you very much.
Vicky, I could maybe just add on that. Is my take on KYC would be, you know, the really critical thing is obviously how do you identify the market participants, and the approach we've used, Matt, I think is the approach you've used also on your platform is essentially custody relationships, right? So using custody relationships, which are obviously very extensively KYC, you know, the identity of the counterparties, that's an excellent way to onboard participants onto platforms. And to Xavier's point earlier, whether you're using public chains, private chains, and we use a combination of both on the HSBC platform, if you know the identity of the counterparties, you're really confident about that, that's a great place to be. And then you can exchange tokens on your platform to those known parties, and that links back to what Philippe was saying about some of the concepts that we've used in Luxembourg. So that's a pretty foundational point in terms of the way these platforms work.
Perfect. Thank you very much.
I totally agree with that. Yeah.
And what about book building? Maybe, Matt, go back to you. Does the use of DLT make the book building process more straightforward and less prone to errors?
I think it kind of will make it more transparent and less manual, and therefore less kind of prone to errors on the forward. I think it's safe to say, certainly in the deals that I've been involved in, we haven't used it for that purpose, because we've actually felt that kind of where we've been focused, where we see more of the value is on that issuance and the post-trade aspect of the transaction. But as you start to see more people and there's kind of other kind of vendors across the market focused on different aspects of the digital life cycle, if you will, I do think it's just a matter of time, and companies like Agora, for example, are really focused on that. But just from my perspective, I think it does improve transparency and naturally removes a lot of the manual work that's involved today.
Thank you. John, do you echo those views as well? Anything else you would like to add?
Yeah, totally agree with that. And then to kind of broaden it out a bit, when I think of that challenge of book building, I'm thinking there's, take a step back, there's two kind of essential parts of that really, right? There's processing, and we've already mentioned that is one of the real potentials of this technology, and we're already realizing some of it, but we can realize a lot more. It's more efficient, lower tendency to error in terms of processing. Also, when we're thinking about building a book for primary issuance, we're thinking about liquidity, of course, and there's probably a lot more we can do about later in this conversation, but a lot of the developments that we're all undertaking at the moment are about adding new market facilities, building liquidity, making these bonds as liquid as current conventional bonds, and that's going to be attractive to issuers like the EIB and others.
Absolutely. Okay, John, let's stay with you. In terms of considering the wider impact here, how do you see the industry ecosystem developing with regard to primary issuance? Yeah,
so both for primary and secondary, really, it's kind of a continuation of what I said already, really. So if you think about the market state we're in, I always think it's really fair for us to emphasize it's pretty nascent, right? You know, HSBC and Goldman Sachs on this call both have started platforms, and other banks have as well. There's realistically a very small number of bonds on those platforms. We can all do much more, so it's exciting to be at the start of this journey. The way we'll do more, I think, and as I just said in the previous answer, where we'll attract more issuers. EIB have been very forward-looking, Xavier, and I think you want to be involved in these latest developments. The way we can attract an even wider range of issuers and hopefully do even more issuances with EIB is we can promote secondary trading. So we've done some secondary trading on our platform, but most of the liquidity has been in the primary issuance, to be honest. So there will be more secondary trading. We can also build in facilities into our trades which are completely common for existing non-digital bonds. So repo facilities, a wider link to market infrastructure. And I think what success looks like for a market like this is it pretty much having all the facilities of existing non-digital bonds, but having that better processing, shorter settlement times, which we'll probably talk more about later. That's really important, and just being more efficient and bringing potentially even more liquidity to the market once you have those full range of market facilities up and running. So lots more to build out both across primary and secondary, I think.
Thank you very much, John. Interesting. I'm sure we will reflect on these early days in years to come. So far we've touched on the reasons and the challenges behind issuance and how the book building process works. But I wonder, what about post-trade aspects? Xavier, maybe we can come back to you. What were the processes behind settlement and payment for each of the issues?
Sorry, yeah, I was disconnected. Yeah, I was disconnected for a second, so I didn't hear your question. So
sorry, I was just saying, what were the processes behind the settlements and payments for each of the issues you've done?
Well, it depends on the transaction, because each transaction has its specific model. On some transaction, we've been using experimental CBDC provided by the Banque de France in one case, Banque de France and Banque de Luxembourg in a second case. And in the case of HSBC, we've been using some commercial bank money. But the idea was, in each case, to have some cash on chain solution in order to facilitate the payments. However, something maybe that is worth noting, because it's very easy when we talk about blockchain to discuss about the benefits, saying that, okay, if you use blockchain, it will allow faster settlement and all that, okay, which is great. However, I have to say that there are many obstacles, okay? So for instance, when it comes to bonds and the settlement, in order to be able to instant settle, well, you need to have the documentation ready. Typically, it takes 5 days to draft a bond documentation. So that's why when the EIB is issuing a normal bond, we are settling the bond T+5. The bulk of that process is done is because of the legal drafting, okay? And you can issue in DLT all you want. You cannot cut that drafting time, okay? So I think for the post-settlement aspect, there will still be a lot of constraints on the legal side, okay? So that's the first bit. And then on the blockchain and flow of money point of view, at some stage, it's not even clear what are the benefits of the faster settlement, okay? Because there are other benefits in terms of programmability, in terms of safety, and so on. But when it comes to just the faster settlement, let me give you a very quick example. When we did the latest Euro transaction, the one on the Goldman Sachs platform, so basically, I will not go into detail, but the cash, there was a fairly complex system for the cash, where the cash basically was going to Banque de France. Banque de France was creating a token, and then the token was exchanged against the digital bonds, and then it was sent to Banque de Luxembourg that was burning the token, and so on and so on. So it was a fairly complex process to end up to break it down to a simple DVP between the bonds and the cash, okay? Accessory to that bond issuance, we also had a swap issuance, okay? And the swap was off-chain. So Goldman had to send money T+0 because the bond has to match the swap, right? But the swap was off-chain. And how did they do that? Well, they just did a wire transfer, okay? And we received money same day, T+0 settlement with just simple wire transfer. So yes, blockchain in theory can allow for faster settlement, but between the legal obstacles and the fact that you can already settle money T+0 with normal wire transfer, I'm not sure it's one of the major benefits of blockchain.
Yeah, let me, I'll kind of play devil's advocate on a few of those points as we've done before. So in terms of kind of the need for legal documentation and a period T+5 or whatever it is, I don't subscribe to that. I do firmly believe over time you'll be able to digitize documentation, and that could be done in pretty much short order, and you can even do that pre-T, to be brutally honest. other than if it's fixed floating. But I take the point. The fundamental point is spot on. And I think people do get a little bit fixated with the T+0. And yes, as Xavier said, the actual settlement cycle for the EIB was 60 seconds or inside 60 seconds. But there were kind of other aspects. And some of that's because of the nascence of the technology. For me, it's more about the precision. Like liquidity and capital are becoming ever more scarce because of the macro backdrop. This ability to know that you're going to settle T+2 on this minute, that's powerful, because for everyone involved, it just gives them the confidence that that settlement will happen and there won't be kind of problems in terms of accidentally allocating the cash somewhere. And these problems happen in today's world. So you eliminate a lot of the kind of operational and settlement risks. So I guess that's kind of one of the key points. The point about moving it in the RTGS system, again, totally agree. I mean, they're pretty kind of impressive, you know, across all the different sovereigns, but they only work in the hours of the daylight they're open, right? So in Europe, that's whatever it is, 9 to 4:30 or 5. So what you do get on DLT, once there is, you know, a digital money that's fit for purpose, you will have kind of broader kind of operating hours, which probably won't be suitable 24/7, but 24/5 could be very powerful. And then that kind of leads me to think about, you know, the different digital currencies. And I think, you know, kind of Xavier touched on them, you know, with our deal and HSBC deal. When I think about the options, you've got the trigger solution, which is a bit of a hybrid. You have digitization of deposits, you have stable coins, you have wholesale CBDCs. And I do think digitizing deposits and wholesale CBDCs is where the market is really coalescing. But you actually need them on chain to really extract the full benefit. And we're not quite there yet. So that's a little way off. And so I think some of the benefits that people do, you know, talk about quite consistently, and I'm one of those people, I think once you actually kind of have, you know, firmer regulatory clarity, once you actually have scalable, ubiquitous digital money on chain, which, you know, isn't as far away as it was in 2020, it's much closer. I think then you can really start to see these benefits and adoption accelerate. One of the key impediments at the moment for investors is the lack of secondary liquidity, and that's a regulatory point. The other point that probably John will mention as well is in and around the custody. There's a lot of custodians today who act for a number of different investors who can't custody digital assets. So the kind of the FMIs more broadly, this technology is an existential threat. There is no question about that. And so you're seeing increasingly more actually invest time, and you can name a whole list of them. So again, you know, people are addressing that, but again, it's down to the nascence of the technology. Once you start to see the EU approve markets in crypto assets and things like that, that becomes really powerful. And actually, just going back to the question before, because you skipped me actually, there's a couple of things I just really quickly wanted to mention on the actual kind of tokenization. I think BIS actually did a really interesting piece on this. So they did something, a little kind of bulletin, which was kind of called Tokenization Continuum. And this really kind of focused on where people are looking in terms of tokenizing assets. And they focused on the more vanilla side. And they said, look, that's where they see, you know, greater kind of focus and energy. And there's a number of people I've met in the market, kind of unrelated to the sell side, who have done a lot of due diligence in this space. And they think the savings even there are up to 40%. So they're quite profound. And this is like a number of independent people who've been looking at this. And so there's a lot of people who have looked at the number of tokenizations we're going to see this year. 15, I think it was 20 last year, 15, 20 last year. They're looking at in excess of 75. And you're starting to see a little bit of a migration to other asset classes as well. But going back to that kind of tokenization continuum, they say the volumes, and you'll start to see some benefits flow with adoption on the more vanilla. And then you start to see as the technology becomes a little bit more user-friendly in different asset classes. And the ones that people regularly talk about, funds, obviously, real estate, etc. So I just think that they're kind of, key points.
No, I think just on the point around the legal side, I think the reality, and you mentioned it, Xavier and Matt, both of you, is that ultimately this is new, right? So there's no market standard documentation. So each deal has different features, and obviously these need to be documented differently. So this is why I think this could have been a pain point for the first issuances, but that's obviously when it hits the market and we have more frequency of these issuances, I think that problem will go away on its own.
I think this part of the conversation is a really fun part of the conversation, because I always think on this subject, the first time everyone on this call might have slightly different years, right? But when they had this experience, but the first time our bank, anyone said to me, tokenization is going to be really important. It's going to change everything. It was 2015, right? So that's 8 years ago now. And I don't know how it was for Matt and Xavier and others, but everyone said it won't happen quickly. It'll probably take 3 or 4 years. It'll probably take 3 or 4 years, and then everything will be on chain. And clearly, we're 8 years later, and very little is so far. Even though we're happy to have done the work we've done. And I always think a good question to ask is, well, what's retarded the development of that, and how are those obstacles, how they've been removed? And I think we've touched on 2 of those obstacles already, right? So that was mentioned, different forms of digital money. I think that just hasn't been mature at all. We've got the CBDC conversation has come a long way, but also for all the currencies we've mentioned in this call, it's just factual. There's no CBDCs. There's experimental CBDCs and simulated CBDCs, and we've all been involved with those in different manners. But the CBDC conversation has a long way to go. Then we've got tokenized commercial bank money, which is the approach we've used for our transaction. We think it's a really good approach. But then there's tokenized deposits that are coming in, and there's even the potential, subject to proper regulation, stablecoins and other forms, if they're well regulated. We don't know there yet. So that money part has come a long way. And then I think the other fundamental part we've also touched on is, particularly Philippe and Daniel were touching on it, is legal regimes, right? So we really like the regulatory regime in Luxembourg. That's why we put our platform there. There's a particular status called a central account keeper, so we're plugged into that. But those kind of regimes just didn't exist, and that developed in clear form certainly 8 years ago, and even more recently than that. So you're seeing those building blocks come together. And I think as they come together, is just the experience we were talking about 5-10 minutes ago, is there's that old funny joke about blockchain, that blockchain would be great when the whole world's on blockchain, right? So sometimes when you're building one of these platforms, you feel you've built a small perfect thing, but all the ancillary systems, all the market connectivity just isn't there yet, and you can't realize the benefits. And I think that's many of the things that Xavier was saying. I very much agree with Matt. I don't think all of that's going to happen overnight. I think you have to create facts on the grounds, and these platforms are facts on the ground, and that will start to improve the ecosystem, and then you're going to start to see those benefits, and the liquidity is going to come. So lots happening, I think, but it's getting really substantial now.
Yeah, and sorry, I'd add on that as well. I think, I don't have an experience back to 2015. I started in my old job, actually becoming kind of quite involved in this space around 18, 19. But I do think, from taking over the business in 20 to where we are today, the regulatory backdrop has changed kind of immeasurably and beyond, kind of all recognition in a very positive way. And I think the other key thing is just the breadth of traditional financial institutions that now are involved. And that wasn't, kind of a function, even 3 years ago. You got kind of FMIs, the buy side, inside, looking at digital asset strategies, teams, creating teams. And it's because they've done their due diligence and they recognize there is an interesting kind of opportunity in terms of transforming their business. The question, to John's point, is no one quite knows how long that will be. But I think we're in a much, much better position today where the planets are aligning a lot more effectively.
And at the risk of going on, it says I completely agree with all of that. And I think if you're thinking this is finally the inflection point, which is the idea we're throwing around, where there's lots of customers on this call, right, is one of the real motivations I find, it's probably the same for other banks, is the reason people want to get involved is just to experience what this feels like, put it through their compliance regimes, their lawyers, others, get their technologies used to it. And often they find, if you build the platforms in a certain way, it's surprisingly easy for them to do, and it gives them a stake in that future. So that's, I think, an important point for the industry at the moment.
Thank you, John. So it's very clear that things are evolving quite quickly, which is great to see, actually. Now, issuance is all well and good, but you do need investors to buy the bonds as well, and a certain amount of traction then to build a liquid market. John, maybe staying with you, how difficult and time-consuming was the process of getting the buy side comfortable with subscribing to bonds in this new format?
I think it worked pretty well. To be really frank, a lot of experience, I'm interested in Matt, will have a similar experience, is when you first describe these things to buy-side firms, there's two reactions. They're both intensely interested because it's a new thing. There's also a bit of just mild discomfort because it's a new thing, right? There's a different sides of the same coin. And one way we approached building the Orion platform is what we didn't think would be at all smart is if we developed a very performative platform which settled in real time, and we went to buy-side firms and we said, well, we've got this great new platform, and all you have to do is 6 months of development work and you'll connect to it. And I'm pretty sure all those firms would have said, well, good luck with your new platform. We've got other things to do for 6 months. So the key is making it as easy as possible for users to onboard. And that goes back to what I said right at the beginning, really, which is coming through custody relationships. If you're a buy-side firm, you have an existing custody relationship with HSBC, or also one of the other joint lead managers in our syndicate for the Mars issuance that we did with EIB, is you can use those custody relationships because they're KYC to access our platform, the Orion platform, and you can come into the bond that way. So, Victor, the answer is, at first, people take a little bit of a breath when they see these assets because they're aware they're undertaking something new, but they're often pleasantly surprised at how easy it is to connect. Typically, it tends to be a compliance legal conversation, actually. It doesn't tend to be a technology build. These bonds have ISINs, they can be straight through processed. So I think people generally pleasantly surprised, but there's always just a putting your toe in the water kind of experience.
Yeah, I mean, in terms of adding to that, I mean, I think there is no lack of interest on the investor side, and what we've seen in different forums, people kind of highlight, I guess, the second liquidity point being a key obstacle because they have a fiduciary responsibility for their own kind of investors. So that's, a key impediment. And I think once that's, kind of addressed, I do think there will be a kind of a big sea change in terms of, adoption. I do completely agree also with John's point on custody, for a client to actually kind of invest in a bond, EIB or HKMA that was issued recently onto the platform, they do need to have custodians who have the technical ability to hold it and actually be onboarded onto the platform.
Yeah, and I think a point to add there is just, obviously this goes towards the intermediated model. So whereby you can have a global custodian and even kind of replicating what has been happening sort of in the clearing systems. But as well, I think what we can safely say is that maybe alternative models could also emerge where you won't necessarily have such a vertical custody chain, but also more of a horizontal one. But again, that needs to be thought through, and that gives rise to let's say, again, additional novelties, even the way we construe the capital markets and how investors could interact with issuers and vice versa. So I think this is all for grabs again.
So it's great that there is interest there. It's fantastic, especially with something so innovative as well. Matt, maybe back to you. What are the main logistical factors to consider in the context of secondary market trading here? And how do you see that landscape of secondary liquidity developing further?
I guess it comes back a little bit to the regulatory backdrop. I mean, because of CSDR, obviously, for example, within the EU, this inability to kind of use, normal trading venues to create secondary liquidity. So having and applying to be part of the EU pilot, for example, will give us the opportunity to actually kind of market make in a more traditional way on chain. So, and if you look in the UK as well, you've obviously got the FMI sandbox, which is looking at something quite similar. So I think, looking at that, that's, an area that we're very focused on. Outside of Europe and the UK, you look at kind of the US, I mean, they already have digital asset licensed ATSs. So there's kind of a myriad of other challenges there. But I do think it's kind of moving forward, but it's not something that's going to happen overnight. But it's definitely, kind of in the short to medium term.
Okay, thank you very much. And John, linking in with this liquidity aspect as well, what limitations do the use of private-only blockchains have in terms of liquidity?
Yeah, so just noting Xavier's comments right at the beginning in terms of private and public chains, and so it sounds like you're thinking of that, Xavier, is pretty kind of neutral between the two in principle. I think that's smart because one probably fairly unique part of the HSBC platform is we have both a private and public chain connectivity, right? And just to explain that, is the private chain is the legal record of all holdings, so everything that legally matters, and the most important side is actually private. And the reason, the benefits of using a private chain is everything we talked about, custody relationships, it's secure, it's behind our firewalls, our cybersecurity, That's a really nice, tight way to do it. We also wanted to build public chain connectivity, and users can also access their holdings on the public chain. So, but that's optional. They don't need to. Okay, and there's lots of reasons why we did that. But just in a nutshell, I would say philosophically, when we look at this space, public and private chains, I think a really sort of hot topic and hot question at the moment is people want to say, no, it will go to private or it will go to public, but people want to kind of back a horse. We think that's completely premature. We also think that's a bit ideological, to be honest. We think there's benefits to do with public chains and private chains. Particularly for private chains, the maturity of the regulation is going to be really important, and that's developing more and more. The key thing is that you KYC your customers, you handle financial crime risks, which we have to handle for normal non-digital transactions already, and that you take a really kind of smart and compliant approach. And I also, one analogy I use, and this analogy probably has limits, but about 8-9 years ago, really not my area, but people were very passionate about whether public or private cloud computing would prevail, and both still exist, right? Both being made to work. One is predominated more than the other, but both still exist. And also from a more markets perspective, in FX markets, I'm old enough to remember when people were very passionate that single dealer platforms or multi-dealer platforms would prevail. They both still exist. They've evolved a bit over time. So in short, we think both have real value. We like the openness of public chains. We think the public chain connectivity and regulation has far more longer to run in terms of maturity. But the reason we wanted to create that public connectivity as well as the private connectivity on our platform is it gives us a stake in the ground. It gives us the potential to build out further as that matures, Vicky. So yeah, I think I'll be fairly open-minded on the possibilities for both at the moment. That's certainly our take.
Yeah, I don't have too much more to add than that, than perhaps, the considerations, particularly, from our perspective, our regulatory, and also just what we hear from our clients. And I think the ideological point is a very good one. But I do think a lot of people feel, a lot more comfortable with the privacy, the security, and the walled gardens initially dipping their toes into this marketplace. But I think, the opportunities as the public chains do mature and people get more comfortable will be significant.
Thank you very much. Xavier, let's come back to you. What are your thoughts around your listing? So having both traditional and digital formats that are fungible and transferable between formats.
Well, we don't think listing is a very important feature, to be honest. Okay. At least because in the bond market, most of the trading is happening OTC. Like 90% of the trading is happening OTC. So even for non-digital bond, listing has a very limited impact. Okay. Of course, when it comes to digital bond, given that one of the major hurdles that we face at the moment is the lack of liquidity. Okay. Having some form of executable listing could help enhance the liquidity, okay? But I think in the short term, the biggest obstacle is rather the custody aspect rather than the pure liquidity aspects. Investors are simply not willing to jump ships and open new custody relationship with various platforms, okay? They have their own custodian banks, and as long as these banks are not really connected, for investors, it's problematic. So
Xavier, thank you for that. John, Matthew, any thoughts about that at all?
I'll just say from my part, yeah, very much endorse that. I think a wider range of customer relationships, was the point Xavier was making, essentially, is really important. And for firms, going back to what I said sort of 5-10 minutes ago, is the real attraction is if you can use this new format in a fairly easy to onboard manner, you're not going to necessarily change your general custodian relationships or other related relationships in order to connect to an individual bond, right? So the key is providing straight through processing in the widest sense. So at an investor buy-side firm, you can use your current custodians, you can connect onto platforms, you can deal with banks that you know and trust already in terms of platform operators, and you can transact digital bonds that way. So yeah, it's all part of building out that picture.
Yeah, I don't have too much more to add.
Thank you. And do you see this having an impact on liquidity then?
I think I think all of this is about liquidity, right? Ultimately, because markets are about liquidity. And I think, a wider range of custodians, and going back to some of the market facility points we mentioned earlier, will improve liquidity. But I suppose, Xavier, what you're saying in particular is that's the most important element of improving liquidity is the custody relationships, and that's certainly the way we view it.
Because clearly what you need to understand is that in order to have liquidity, you need to have many investors. Because if you only have a couple of investors, well, by definition, you can do whatever you want. You will never really have true liquidity, right? So first, you need to onboard as many investors as possible, which is related to the custody aspects. And then you can work on some aspects. Listing is one of them to improve the liquidity, but that's a second order.
100%.
Yeah, I completely agree with that. And I think actually, if you think about this dual kind of listing concept, I mean, that's only valuable if, to Xavier's point, it kind of encourages more people to actually kind of invest because they have the confidence being able to flip between the two. So naturally, you'll have liquidity in the traditional form, and then I guess over time you hope that obviously kind of is kind of represented in the digital form as well as the regulations evolve.
I think also one way to view this is sometimes maybe you get the same thing. People say, well, what about more customer relationships on the platforms? And I'm sure we're both building those out. But what people almost forget is incumbency, right? So at the moment, if you trade a non-digital bond, you do so even if you don't think about it as a buy-side firm through a whole series of customer relationships. It's just because those are all in place. They've been put in place over decades. So you're kind of replicating that approach in this digital format. So that takes a little bit of time, but there's a lot of willingness to do it, I think.
Perfect. Thank you very much indeed. Now, I just want to remind our audience that there is the ability to submit questions, if you like, for the panelists. We have a few minutes where we will be able to answer them. So if you click on the bottom where it says Q&A, you should be able to submit your question there. Whilst you might be considering that, I would like to pose another question, and probably final question, to the panel. And it's more of a forward-looking approach. It's how do we see the secondary market infrastructure developing to really facilitate a truly multilateral environment? John, as you're on the screen, maybe we start with you.
Yeah, well, I think if we think of the way non-digital bonds work at the moment, some bonds are extremely liquid, right? They'll trade on electronic trading platforms, other trade voice and chat, and are transacted off-screen, as it were. I think what you see for these initial digital bond issuances is they're not hyper-liquid, right? They're a certain size, they're not a massive benchmark size, they're not trading on electronic platforms. And as all the things that we've been talking about over the last 50 minutes happen, right? All those custodians come in, the market facilities come in, the liquidity increases, all those fundamental barriers to liquidity increase. You'll see, as liquidity increases, the demand for more secondary market access options. So I think it is realistic to start to see digital bonds trading on screen on electronic platforms. That hasn't been the case so far. These have been traded on the phone and voice really at the moment. And I think that potential will build out. So Vicky's a bit of a repeat of the previous answer. I think all those things come naturally as liquidity comes. And then, as always, when markets transform and market structure changes, there's the potential for new actors, new providers to come into the space and take advantage of the underlying benefits of the technology, which is better processing. So yeah, those are the different things I would expect to play out over the next few months and years as this gets a bit more popular.
Yeah, I mean, I think the EU pilot, just using that as an example, could be a good proxy to see how this could actually evolve as you can experiment more. I mean, there are certain limitations on the pilot, but I do think that, could be a very good proxy. I also think as you look to kind of consolidate the value chain, and actually you could even have kind of FMIs who could actually kind of play the role of trading and settlement, or that could also be quite interesting as you start to see this marketplace evolve. But, we've touched on many of the other points as well already.
Thank you very much. Now, I see we have a few audience questions coming in, so let's see if we can get through those. The first one that's come in is Xavier, aimed at you. Are you planning any further DLT bond issuances that you want to tell us about? If so, when?
So yes, we are looking at 2 potential projects for this year. Okay, projects that I've been working on already for a couple of years, but I can't give details because the transaction is not public yet. So
it's good to know you got 2 more coming. Thank you very much. Excuse me. The second question, yes, there will be a recording of this session made available to attendees. The next question is around interoperability. Interesting one. So how vital is interoperability between chains to the growth and adoption of digital bonds? Who would like to answer that one?
I can give a very short answer. I think it's kind of key, quite frankly. One of the things that the IS, for example, have been talking about is kind of this unified ledger, which I think is a great utopian goal, but I think the reality is that'd be very difficult to kind of ultimately kind of achieve for a variety of different reasons. But I think interoperability between platforms, and John and I both use digital asset holdings DAML, kind of smart contract language, and they announced yesterday Canton, which is designed to create interoperability between different kind of platforms using DAML. And I think that just emphasizes, you know, the real importance of that interoperability and that ability to be kind of truly scalable across multiple platforms. So kind of in short, I think it's hugely valuable and important.
Yeah, I totally endorse that. And I always think for interoperability, well, there's multiple dimensions, but there's 2 prominent dimensions. One is the technical dimension, so Canton Network's excellent for that. But then there's also the kind of regulatory dimension, linking platforms, get into that kind of dream stage where you could possibly open transactions on one platform and close them on another platform. That takes a much more, typically a lot of the, where there is post-trade at the back end in terms of regulation and infrastructure. So tech's really important. But one thing I say for this subject a lot is it's not just technology, obviously, it's risk, it's regulation, it's law.
Yeah, but I think just to add that in the traditional world, you know, we do have ICSDs that do provide bridges across CSD platforms. So I think it's just a natural way of flowing, actually, that we end up with the same interoperability.
Yeah, Philippe, I think an interesting question will be is to what degree, as that liquidity builds out and all the infrastructure grows for digital bonds, does it replicate current infrastructure or is it substantially different? And that's always hard to predict.
Yeah, I think it will be different in nature, but just in terms of connecting investors and connecting issuers across the world, you know, that this is where you would need maybe, whether it comes through Canton as you know, an overarching layer that connects all the different platforms, or even just a programming language, or through custodians. I think there's different ways to achieve that. But it is necessary, at least in my view.
Yep.
Thank you. Another question. We've got quite a few questions coming in, so I'm going to be a little bit selective here. How did Xavier? How did the EIB choose the size of its transactions, and was the issuance cost higher or lower than a traditional bond?
Well, we wanted to achieve a minimum size, so we set the size at between 50 and 100 million equivalent, depending on the market, in order to make sure that it was not a simple test trade of 1 million, something like that. Okay, so it has to be at least private placement type of size, and then the issuance cost. From a pure financial point of view, it was the same. So the bonds were priced in line with the EIB curve. Obviously, the legal costs were much higher than for a normal bond. So if you factor in, then it was more expensive clearly to issue a digital bond than it would be to issue a normal bond, and much more lengthy, right? It took, on average, each project took 2 years to complete.
Wow. Thank you very much. And I think our final question, just looking at the time, what else do you think, and this again is to you, Xavier, needs to happen to make digital bonds more attractive to issuers?
How long do I have? So
2 minutes.
No, well, many things need to happen. We need to have more legal clarity. Okay, we need also to have more clarity on the regulatory front. Okay, we need to have connectivity. By connectivity, I include everything, which is the liquidity, access to the platform, all the custody aspects, so that whoever wants to buy the transaction is indeed able to buy it without much friction. And then issuers, they will need to build up the expertise, and that's why the EIB wanted to start that process very early, because it's a very, very complex situation, right? So we've been working on these topics for about 4 years now, and when we did the first transaction with Société Générale, Goldman, and Santander, we reused the exact same group to do another euro transaction. So the first transaction was a euro transaction. We did with the exact same group another euro transaction. It still took 2 years to bring that new transaction to the market. And they have, together with HSBC, immense expertise in that field. As far as issuers are concerned, we are probably the most knowledgeable on that topic. But it's so complex that I think issuers will need to have the ability, the knowledge, the resources to tackle that. And hopefully, when all these aspects that I was mentioning previously are cleared, like on the regulatory front and so on, it will lower the barrier to entry, so that the input from the issuer side will be lower, which means that more and more issuers will be able to look at that market.
Thank you, Xavier. Okay, I'm afraid that's all we've got time for in terms of questions. So apologies to those that we weren't able to get round to. We will hopefully be having another session at some stage, so keep those questions for then. Lastly, I would just like to ask each of the panelists to leave us with a key point each that we can close on. Xavier, do you want to start off?
Yeah, if you want to get involved, start early, right? Because it's a complex process. Be patient and be ready for everything, okay? And have good lawyers.
Philippe, anything you want to add?
Yeah, I think there's no telling where it's going to go. I think we have a panel with roughly sized banks and very sophisticated issuers, etc. And I think the answers seem to be fairly aligned, but actually the vision could be quite different. And there's a lot of tools in the toolbox, and there's different ways that you could approach these projects. And so, yeah, I think right now we're just starting putting everything in shape, and we'll see the way the market develops. But yes, creativity is very key.
Thank you, Philippe. Dan, do you have any points to leave us with?
Well, I certainly endorse what Xavier said, to get yourself good lawyers, but I think I'd echo a sentiment John expressed earlier, and that's to encourage people to dip their toes in the water. You know, we talk with a number of clients on these structures. Some are all over them, some less so. Some are hugely enthusiastic about the potential of DLT in this space. Others are a bit more skeptical. But I guess the key message is, if you want the opportunity to shape how these technologies underpin the capital markets of tomorrow, then now's a great time to get involved.
Thank you. Matt?
All I'd say is that, despite kind of some of what we've said, this is happening much quicker than I think we can anticipate. So inertia really isn't an option. So.
Good point. Thank you.
I think from my part, the key is just reflecting what Dan and Matt have just said there. Really, I think this is the pivotal year, right? So we're certainly really glad to have a platform out there in the market. It's all about liquidity, because as I've said, market's all about liquidity. We think the constraints are developing digital money, developing the regulation. Both of those are moving fast. Things are coming through, and I will play tag team with Dan. We encourage everyone. This is easier to get involved with if you choose the right platforms. I think we've got 2 of the right platforms in this call than you might think. Getting investors on board, investing in these bonds. That's liquidity begets liquidity. So that's a good place to be in 2023, I think.
Absolutely. Thank you very much indeed, John. And on that note, I would like to thank our panelists today for a very informative discussion. I really do hope we are able to continue looking at digital bonds in another webinar as part of this series. Incidentally, GFMA, the Global Financial Markets Association, which AFME is a member, will be releasing their report looking at the impact of DLT on global capital markets next week on the 17th of May, which I'm sure will be of interest to participants in this webinar. And thank you to everybody who has joined us online today. I hope you've enjoyed it. And until next time, goodbye.